Thank you very much, Pascal, and thank you very much to the World Bank for arranging and sponsoring and financing and doing everything that they have done to make this possible. And thank you all for attending. I really think that regulators are one of the most important pieces of the puzzle of getting good application of IFRS around the world. So I'm a former academic. I used to teach IFRS at a South African university. And I know from those days that if you set your exam well, the students learn well if they understand what you're going to examine them on. And I think it's the same with applying IFRS. I think if the regulators are regulating well, the companies understand well what they have to do in order to meet the requirements that the regulators are setting. So it's all about getting a good flow of capital around the world. That's what IFRS is trying to do. It's one piece of the puzzle of trying to get capital to flow more equitably around the world and a lower cost of capital for companies. That's what it's part of the puzzle, just like regulation is part of that puzzle too. So it's about getting money from people that have money to invest to the businesses that need the money to grow. So we need good accounting standards, we need good corporate governance, we need good auditing, we need good regulation, and for all of that we need good understanding of IFRS, which comes from education. So education in your jurisdictions in accounting is very important. So I have a standard disclaimer too, so anything I say is just my view and not necessarily the view of the board or the foundation or anybody else, but it is my view. Now, Martin gave a brilliant presentation, I think, and he said he would make accounting interesting. I'm going to try and do one better. I'm going to try to make accounting exciting today. So, okay, so basically what we think, if we can tie our understanding of IFRS around the conceptual framework, then we think that people will have a more robust understanding, they will understand better, they will be able to make the judgments and estimates better that need to be made to apply the standard, and Martin was speaking about some of those, and for the rest of the workshop, that's what we're focusing on. How do you make the judgments and estimates that are necessary to apply these standards? So we think to have a framework-based understanding, we should always be tying our understanding of a particular requirement back to the conceptual framework. And it doesn't always work, because sometimes the requirement was written before the conceptual framework was written. So you need to understand where it doesn't tie back, why it doesn't tie back. And you'll see there are other reasons why things don't tie back as well. And this means when you're looking at the requirements in IFRS, it is helpful to also look at the basis for conclusions that the board publishes about why they made the decisions that they made. So why didn't they require what you might think the obvious information would be to meet the objective? So it's useful to have a look at the basis for conclusions. Okay, and it's all about judgment. Okay, so I was speaking about this way of looking at it will tie our understanding around the conceptual framework, so we'll have a cohesive understanding. It'll provide a basis to support the judgments that we need to make. And the case studies that you looked at, the first case study we're going to do this afternoon, is about where there is no explicit IFRS requirement to account for a particular transaction or event. There's just no IFRS that deals with that particular issue. But the issue still needs to be accounted for. So how do we go about accounting for those things? And that's our first case study today. And we also think if you tie your knowledge around the conceptual framework, as IFRS updates, so you've seen IFRS 10, 11, 12, 13 all becoming effective this year, it helps you to update. So how does it help? The conceptual framework is what the IASB uses when they set IFRS. So if we were the board, if we collectively had to write an accounting standard for something, We don't just sit there as individuals and say, well, I think this information would be nice, you think that information would be nice, you think some different information would be nice. We have these concepts that say, this is the foundation on which we are building our standards. Any requirement that we're going to set should be consistent with those concepts. And if it's not, we must explain why it is not. Okay, so we tie all of IFRS around these particular concepts. And you'll see in the first case study that we do today, if there is no explicit requirement in IFRS to account for a particular transaction or event, but the transaction or event has occurred, then we look back to the conceptual framework to write an accounting policy to make the judgments and estimates that are necessary to apply and set that accounting policy. And you, the guys who regulate the people who make those judgments, so the auditor checks the judgments and then you check the auditor's checked judgments. Okay, so what is in this conceptual framework? Because many people around the world seem to use IFRS without reference to the conceptual framework. So many countries, when they put IFRS into law, put IFRS into law without putting the conceptual framework into the law. Yet there's a requirement in IFRS, which we're going to spend our first case study on, that says basically if there's no explicit IFRS requirement, you come back to the conceptual framework. So to apply IFRS for that reason alone, you need the conceptual framework. Okay, so it is important. Okay, so the most important thing that the conceptual framework does is it says what is the objective of financial reporting. And that objective Martin touched on, and some of the other speakers as well, is different from prudential regulation. It's not the same objective. Okay, so it's important that we look at financial information when it's IFRS financial statements, and we understand the objective with which that information is prepared, because it is different from prudential regulation. And once we've got the objective, we can say, well, what qualities does that financial information need? We can define the elements, assets, liabilities, income, expenses. We can set some recognition criteria for when we put things in the balance sheet. You might think, well, if I've got an asset or a liability, I should put it in my balance sheet. That would be perfectly reasonable if you're an economist, and I understand many of you are. If there's an asset or a liability, you would put it in the balance sheet, wouldn't you? Seems reasonable to me. But IFRS says no. Once you see whether you have an asset or a liability, you then check to see whether you meet the recognition criteria for an asset and a liability. There's an extra step. And then there's derecognition, which is when you take something off the balance sheet. Okay, and the time that you take it off the balance sheet, and Martin was touching on this in one of his examples, the time when it goes off the balance sheet is not necessarily the opposite of the time when it would go onto the balance sheet. And we're going to spend some time looking at derecognition as well. So accounting could be simpler. We could just say when you have an asset, it goes on the balance sheet. When you no longer have an asset, you take it off the balance sheet. That would be easy. Okay, but it is a bit more complicated than that. Okay, because we set these thresholds for recognition, and then we have different thresholds for derecognition. And then there's measurement. So once we've decided we're going to recognize something, what amount do we put it at in our balance sheet? Sounds easy, doesn't it? Okay, we have more fights over measurement than anything else. Okay, and then we present and disclose that information. But the last point on that slide, everything in this conceptual framework focuses on the objective of financial reporting. Every requirement that we have in IFRS focuses on the objective of financial reporting. So the most important thing to understand IFRS is to understand the objective of financial reporting. And there are many misunderstandings of that objective in the world today. So this is the objective, and we're going to come back to it in everything that we do over the next 5 days. Why? Because it is what IFRS is there to do. It is the core of what we do in IFRS. So look at the focus. Provide financial information about a reporting entity to existing and potential, so shareholders right now and future shareholders, potential shareholders, okay, investors, shareholders, lenders, and other creditors. And that's how narrow it is. It's just that group of people. And it's not that whole group of people. You'll see in a minute, we narrow it down even further. So it's information to help them make resource allocation decisions, make decisions about providing resources to the entity. If it's shares, buy, hold, sell. If it's a lender, advance a loan, retrieve a loan. That's what it's there for. Now look at the second bullet point here, if you like. It's only those existing and potential investors, lenders, and other creditors who cannot require that reporting entity to provide information directly to them. So it's not a controlling shareholder. It's you and me who might own some shares in a company and have no basis of forcing that information to provide information to us. It's that level at which we are focused. Then we make some assumptions about these people, about you and me, the investor, lender, or other creditor. We are assumed to have a reasonable knowledge of business and economic activities, and we will review and analyze the information diligently. So that's the assumptions about the user, and that's the focus that we have in IFRS. It's a very narrow focus for a very good reason. Okay, so what we're really trying to do is we're trying to provide financial information that can help these existing and potential investors, lenders, and other creditors who can't demand information from the entity try and make their own forecasts of what the future net cash inflows of that entity will be. So it's providing information to them so that they can make their own forecasts of what the future cash flows of that entity might be. Okay, and to do that, they need information about the assets, the resources that the entity has, the claims against the entity, the liabilities, and our claim as equity holders. And then also stewardship, how efficiently and effectively management have looked after the assets of the entity. So that's what we're trying to do. To do that, we think the information needs two qualities. It must be relevant. So what does relevant mean? Remember what we're trying to do? We're trying to provide information to this narrow group of people to try and help them predict what future cash flows might be. So it's relevant if it's capable of making a difference to their decisions. And to be capable of making a difference to their decisions, it needs to have predictive value, help them predict what future cash flows might be, confirmatory value, confirm their past predictions. And then there's an important thing which doesn't get enough attention in the world called materiality. So IFRS really only applies to material things. So when is something material? If it could make a difference to an investor's decision. So if it couldn't make a difference to an investor's decision, you don't have to disclose it, you don't have to recognize it, you don't have to measure it, you don't have to account for it. You can treat an asset as an expense if it could not affect the user's decision. Notice it's could not, so it's a relatively low threshold. And we'll look at some application of that in the next few days. And it must be a faithful representation of what it's representing. And to be a faithful representation, it must be complete. It must be neutral. So not conservative. This is about transparency. This is about neutrality. It's not to portray a conservative picture. It's to be neutral. And ideally, it should be free from error. Okay, so this is something when I used to audit, I saw a lot of. You have a large listed profitable manufacturer. Their financial statements is in millions of whatever currency you're using. They have an accounting policy that says any individual item of property, plant, and equipment, an asset that we buy, that is less than 1,000, we expense. We don't account for it as an asset, we account for it as an expense. In the year that we're looking at, 20X1, the policy resulted in 100,000 being recognized as an expense. Does this accounting policy contravene IFRS? So when you're regulating this company, and they have done this, have they contravened IFRS? Do you need to call them up and give them a hard time, or whatever you do as a regulator? Or is it okay that they've done this and you don't need to worry them about this? And I want you to discuss it with the people at your table. Yes, they have done something wrong, or no. Sorry, let's just stick with the question as it's written. Does the entity's policy contravene IFRS? Does it break IFRS? Yes, they've done something wrong, or no, it's absolutely fine.
It's not material, so they don't have to. It's contravenes IFRS, but it's not material, so they don't have to reflect that in their financial statement.
Okay, so it does not contravene IFRS. It's fine. There's no problem here because IFRS only applies to material items. Correct. Okay, but we've got both. So the question that the lady's raising is saying, but when you consider materiality, you must consider not only the individual transactions, so the individual purchase that was less than 100,000, but you must also consider collectively. And we said the policy resulted in 100,000 effect on profit in the year. Remember, we're reporting in millions, so the smallest unit that we have is 1 million. This is 10% of 1 million. Okay, it wouldn't even show up in the rounding that we have. That's how small it is. But you're quite right. You must consider materiality collectively. Okay, so that is correct. Okay, so there's no problem. You don't need to phone this company. You don't need to give them a hard time. They haven't done anything wrong. Okay, they're applying IFRS as IFRS is designed to be applied. Okay, now you hear lots of people saying our financial statements are too thick when we apply IFRS because we just disclose everything, and the auditors have a disclosure checklist, don't they? And they tick off, is every disclosure made? And they don't take a step back and say, are there immaterial things here that should be excluded from the financial statements? Because all that clutter can hide important things. If too much immaterial stuff is disclosed, it can hide the material things, can't it?
Should this be disclosed?
There's no need to disclose this.
Like the policy on property, plant and equipment. This year it's 100,000, and next year, due to this policy, it can be 10 million.
Okay, is the 10 million material?
10 million is maybe material, I don't know.
Okay, if the 10 million is material, okay, then the 10 million has to go onto the balance sheet. Okay, if the 10 million is not material, it doesn't go on the balance sheet. It need not be disclosed.
Should I, as an investor, know the policy of this company regarding property, the amortization of property, plant and equipment, as disclosed in the notes of the financial statement?
No. I think, as an investor, I don't care. It's immaterial. It could not affect my decision. If it could affect my decision, then it's not material and it must be there. Okay, if it could not affect my decision because it's immaterial, I don't need to know about it. So say you've got another one I've seen. Say you've got a big company, and a big company, the only lease that the big company has is a finance lease, okay, over some computers in its office. Does it have to capitalize those finance leases, or can it just expense them? Okay, the accounting rule, if you look at IAS 17, says you must capitalize finance leases, but if they're immaterial, they could not affect a user's decision, they can just expense them. That's just like this one here. It's no different. The one on the slide, you see most manufacturers apply this. Everyone in the world seems happy with them. But suddenly, if somebody wants to expense a finance lease, people start getting upset. Well, why? If it's not material, it's not in material error, you don't have to disclose immaterial things, no problem. Okay, so materiality is important.
One question.
Yes?
For the last example, please. We have expenses. For when we recognize the expense, it was immaterial. Then we get that at the end of the year we get some material number, but partly it was expensed already. What we have to do? Recognize the profit, recognize it back. When I make the first expenses, it was really immaterial, and I couldn't imagine that at the end of the year I will get the material number.
Okay. So what you're saying is, at a point in time when you were applying this policy, it was immaterial. So the first year it was immaterial, the second year it was immaterial, the third year it was immaterial?
During the year.
Oh, no, no, no. If it's during the year, and you're doing annual financial statements for the year, then if you expense something in the beginning and you're at the end of the year and it's material, you would fix it for the year. Because those are annual financial statements for that year, and it's material to those financial statements.
I have to bring it back.
Yes. Okay. Okay, so now there's some other, sorry, let's go with the question. We want this to be interactive, so please do ask questions when you want to.
Sorry, I just wanted to add some comments regarding materiality. Me personally, I always had a problem, and I still have a problem with the concept of materiality as prescribed in the conceptual framework of IFRS, especially because IASB has not defined what is material in terms of a really measurable concept. In the conceptual framework, there is just the definition that materiality, what is material for regarding the balance sheet or the P&L account, but then it is that area is left to subjective decision.
Yep.
And anyone can judgmentally decide this is what is material and what is not material. And another aspect why I do have problem with the concept of materiality coming from this prudential background is the consistency. In the example that you have given here, first of all, there are no figures. We cannot judge whether this expense of 1,000 is material from the P&L, from the income statement point of view, or we just need to judge it against the balance sheet. But in terms of consistency, as you went further in the example, if the next year this resulted in 10 million, then we will recognize as an asset. And then in the following year, if it's still 50,000, we will expense it. That's inconsistent for me. I regard it as inconsistent application of accounting policy from the perspective of the reporting entity.
Okay, can I just stop you there so I can just respond to what you said so far, and then you can carry on, because my memory is not so good. I won't remember.
This is just my comment, my personal view, why I always have a problem with the concept of materiality. First, because it is not well defined, and second point of view, because it intervenes with the consistency.
Okay.
Thank you.
So there are a couple of interesting points in there. Okay. And this comes back to making judgments. Okay, because all we say to you is if it could affect a user's decision, it's material. It's not it would affect, it's a lower hurdle. If it could affect a user's decision, then it's material. A lot of people say to us, like you are, okay, that we need more guidance on applying materiality. We need you to tell us, write us a rule. tell us if it's greater than 5% of profit, it's material. If it's less, then it's immaterial. Okay. With principle-based accounting standards, we're unlikely to do that. I mean, we could do that. We could write a rule, but I think we would then get it wrong, because you would find something that is less than 5%, okay, I'm just choosing an arbitrary number, that is material for some other reason. And it's not just amount, it's nature and amount. And this is what applying IFRS is. It's making judgments about things. And you know, there will be some inconsistency between the judgments that some people make and the judgments that other people make. There will be some inconsistency. But I don't think it's inconsistent that in 1 year we expense the 1,000 or the 100,000 or whatever it is, and in the next year we capitalize the 20 million, because the 100,000 is immaterial. So if the next year it's 50,000, expensing it is not inconsistent, in my view, with capitalizing the 2 million or whatever the other number was that I said. Because if it's immaterial, it isn't affecting consistency, in my view. Consistency is only applying to material things. It's not a rule-based system, it's a principle-based system. So if we're expensing 0 or if we're expensing 100 and both numbers are immaterial, it doesn't matter, it's not inconsistent. But when the number that we expense becomes big enough, or its nature is important enough for it to be of a level that it could affect a user's decision, then it matters whether we treat it as an expense or whether we treat it as an asset. Beneath that level, it does not matter. We're consistently treating everything that is immaterial in the it does not matter category, what accounting you do for it. And I think that's important. Okay, and just think about amounts. So if you had a derivative, for example, and the derivative had a very small value, could that derivative affect a user's decision? Yes, because the risks with a derivative are massive. So it's not just the amount and the effect on profit, there's the risks associated with it as well. The nature of the item can affect it. So you have to apply judgment. That's what you sign up to when you sign up to IFRS. You sign up to applying judgment because we want relevant information. And if we write rules, we allow people to structure transactions to get accounting that has an accounting outcome that they want rather than reflecting the economic reality. So the only way around that is to write the best possible principles that we can, and for you guys to check the judgments that people make about those principles. We think we'll get more consistent, more comparable, more relevant information by doing that. Okay, but it does require a different skill set. It's not looking at the rule and saying, did the company debit this and credit that? Okay? It's making judgments about these things. And that's a different skill set. Yeah?
In your opinion, in meaning of individual assessment of assets, is it recommendable just to prescribe the threshold in meaning of materiality for individual assessment, or just to let the banks to make decision what is material in regarding their balance sheets, or just to prescribe some level? It's really difficult to prescribe adequate level for all banking system within one economy.
Yeah, I mean,
What's your opinion? Just to have a threshold, or just to let the bank to make assessment what is material regarding their position
okay,
in the...
from the IFRS perspective, okay, we say it's material if it could affect a user's decision. So that's the threshold. We're not going to provide any more quantitative or qualitative threshold than that, because that's the judgment we're asking people to make. Consider all the facts and circumstances. Could it affect a user's decision? If the answer is no, it's below the threshold. Now, a regulator could set a threshold.
From the perspective of the regulator,
okay,
what would be the...
Okay, but that's a regulatory decision which has a different objective. It could be financial stability, it could be, a whole lot of other objectives which aren't the core objectives of IFRS. So that's why regulatory or prudential regulation layer on extra conditions which aren't in IFRS, because the prudential regulation objective is not exactly the same as the IFRS objective. Okay, so that's outside of the space where I can offer advice, if you like.
As a regulator, we need to take into account both sides, prudential regulation as well as IFRS regulation. I think so.
But when we're writing IFRS, we're focusing only on the objective of financial reporting. So we're saying, we know people use these financial statements for different things. So prudential regulators, for example, use these. They have Basel and they have a whole lot of other things that they use to take this information and adjust it to the, to meet their needs. So it's the starting point, if you like, that they might use for prudential regulation. Then they have other tools in their toolkit to meet the objective, which is different from the IFRS objective. So ours is just focused on, helping those investors, lenders, and other creditors who can't demand information make investment decisions. If we start taking account of all the different things, we'll end up with wishy-washy accounting. So ours is very focused. Yours is focused, but it's focused just from a different angle. So you guys have other tools to get from here to here, I think. That's how I see it working. I've never audited a bank. I've never worked in a bank. So what those adjustments are is really other experts can help you with that. I'm focusing just on IFRS.
But as I have known from the internet, some articles, there are projects regarding the similar solutions, for example, for incurred losses from Basel and IFRS perspectives. It's not just IFRS, as you have already mentioned, but I think so that there are some close issues.
We certainly meet with the banking regulators and other regulators and discuss it with them. But the objective is clear. If you look at our conceptual framework, our objective is clear. Our objective is for those investors, lenders, and other creditors. The banking regulators and others might have different objectives. They have tools to get from here to there. They certainly might try and persuade us to set IFRS in a way that is easier for them to make those reconciliations or adjustments or whatever it is that they need made. So we do have discussions with them, like we have discussions with all stakeholders when we set IFRS. So those discussions happen, and it's part of the process. But our focus, our remit, the thing that we have in the world to say, through a public consultation, we should set IFRS to meet the needs of what's set out in the objective of financial reporting. So that's what we license to do, if you like. Lots of other people try and influence us in different ways, okay, to try and get something closer to what they would like. And our job is really to say, no, our focus is on, investors, lenders, and other creditors. But certainly we have discussions with all stakeholders. And, I'm sure they do have some influence. How about the gentleman over there?
Just one point for Tatiana. I think you can't say, because I need my IFRS financial statement for regulatory purposes, I'm going to have thresholds that are very low to make sure that everything is applied consistently from one bank to the other. And that's for my purpose of micro and macro supervision. Because what that is going to give is going to give too much information. Too much information kills information. You won't have judgment anymore. Everything is going to be rule-based, and then you're going to have a problem. So I think IFRS financial statements, why they're important for supervisors, they complement. They are to the other information. They provide you information on what the transactions are. Is IFRS financial statement deemed to be the only prudential tools? No, probably not.
So thank you. I think I also had a question, probably more high-level question on the objectives, what you are discussing, because I think it's not at least for me it's not really clear where the line is, and we were discussing the macroprudential tools and the Spanish dynamic provisioning system. So basically, for me, like if you have like the example, if you have migration analysis in retail portfolio, so you know that if it's 60 days overdue, certain portion is expected to become 150 days, so you provision immediately. That's probably, some people might call it forward-looking, but that's not forward-looking, because that's all, 60 days is already event, and you already have the information that out of those 60 days overdue portfolio, some large part will going to become 150. That's fine. So that should be probably that should be reflected in the impairment under IFRS. But again, the Spanish dynamic provisioning, it's more about macro prudential and more about cycles. Or I would say a recent example on the gold prices. So basically, gold prices you have in Georgia, it's also popular in many other countries, the pawn shop loans, like the wholesale and retail. So for me, if gold prices are, if the increase is 400 or 500%, probably it is a bubble. So it is a bubble like the real estate bubble. So all those loans are performing. So would it be reflected in the impairment under IFRS? Probably no. But then the question is, what the IFRS 7 is about? Is it supposed to cover this or not? So if it's, at least that's my perception, if it's more clear, then if somebody is a regulator, so he knows this is not covered, so he has to supervise bank with 1/3 of portfolio exposure to gold, whether it is mining or retail or whatsoever. So he knows that something is covered by IFRS, and then he has to add some capital buffers, because you don't want to discuss accounting details, and when gold prices are down, this bank simply fails, despite the fact that all accounting standards are met. So in this regard, probably it's not always clear, where's what's the difference. So maybe, if I don't take too much of your time, so maybe, I mean, first example from our earlier presentation, like all of us know that goodwill is a regulatory filter. So all those profits, like on the example of Bank Santander, so probably the price to book was very high, so all these profits came from goodwill. So if there is no obligation to buy it back, then it's fine. But if there is obligation, so probably regulator would ask, how sustainable are those profits from goodwill? So maybe you deduct it from regulatory capital, and after 3 years, once you don't have any more option to buy it back, then it's fine, and you don't need deduction. So probably in that case you can show profits, but you can't distribute them, because goodwill is a goodwill, and just intuition tells you that probably can be questionable, at least. So again, at least for me, it's not clear, what to expect. From the statement. So again, probably good example, the gold prices. So I think only Singapore's monetary authorities, they increase margins for the traders, and nothing else is going on elsewhere. So.
Well, thank you. If we just bear in mind that at this stage we're just looking at the conceptual framework, though, so we're just looking at the theory which underpins our standards. We're then going to look after the break at the standards which sit above that, and then some of the other speakers are dealing with taking IFRS and reconciling that to prudential regulatory requirements. So at this stage we're just looking at the concepts, the theory which underpins our standards. So maybe if we just focus on that in this session, and then in the later sessions we'll get to the IFRS requirements, and we'll get to how those reconcile to prudential regulation. But I'm really glad you mentioned the gold, because straight after the break, the first example that we look at is how to account for gold, which is held as a store of wealth. And that we'll cover in that session. So thank you. Yeah.
I think it's related to what I just said. There's different objectives. The primary objective of IFRS is to provide the investors to make a business decision. Now, of course, IFRS has a concept of neutrality. Supervisors have a concept of prudence. So that's why also there are some prudential filters. And IFRS is not going to address all the issues of financial bubbles. They can't, because a lot of things, there would be some market value, and the market actually shows the inflated price. And the only way that it can be corrected is probably not from the financial statements perspective, but from the prudential framework perspective. So there are different issues, there are different type of statements. That's why there also is some leeway from the supervisors to add on some prudential requirements.
And I think it's really important that we have this discussion, so that people are aware that when we're looking at IFRS, we are looking at the needs of investors, lenders, and other creditors. We are not focusing specifically on regulatory requirements. We're not focusing specifically on tax requirements or central planning requirements or any other requirements. We focused very narrowly, very precisely on investors, lenders, and other creditors who aren't in a position to demand information from the entity. And that's going to affect everything that we do over the next 5 days, except for the add-ons. The add-ons where you're taking IFRS to prudential regulation, for example. And that's why it's important that prudential regulators have requirements other than IFRS too, to meet their objective, because their objective is different from the objective of financial reporting, I believe. Okay.
And Mike, just one more thing is to go back at what Martin said this morning. IFRS gives you a lot of information. IFRS financial statements give you a lot of information, but it's important to understand the circumstances under which the people who made the financial statements took their decisions. Because this provides you information that actually can make your judgment a bit different from a prudential perspective. So IFRS financial statements are gold because they have a lot of information, but they don't reflect always the prudential that you have to reflect. I think we need to move on.
Yep.
Because
we're going to battle to get through if we don't.
Otherwise, we won't have lunch at all.
Okay, so if information is relevant and it can be faithfully represented, that's fundamental. It needs those two qualities, otherwise we're wasting our time from an investors, lenders, and other creditors' perspective. The things on this slide are nice to haves. If it is relevant and it can be faithfully represented, the information, it is better if it is also comparable It is better if it is also verifiable. It is better if it is timely. It is better if it is understandable. But these things on their own cannot make the information relevant and faithfully represented. So the most important things we're looking for all the time is the information relevant? Does it help these investors and lenders predict future cash flows? And can it be faithfully represented? If those two things are there, then we're ready to look for other qualities. Let's try and make it comparable. Let's try and make it verifiable. Let's try and make it timely. Let's try and make it understandable. But first, is it relevant? Is it relevant to that narrow group that we've defined our objective for? Okay, so now I'm going to make you the standard setter. You've just become an IASB member, and you're going to set the standard, okay, for prior period errors. So an error is made in a prior period. How should we fix the error? How should we require the company to fix the error? And you're going to write, thinking about the objective of financial reporting. And to help you, I'm going to do this. We've got company A and we've got company B. They're identical in every respect. They have the same transactions in the same environment with the same counterparties. They're identical in every respect. Company A does everything right. It reports a profit of 50 for the first year, profit of 50 for the second year. Company B makes a mistake. It reports a profit of 40 for the first year. So now you, the IASB, you're writing a requirement for how Company B should fix the problem. So should Company B show 60 as profit in the second year, 40 plus 60 will be 100, the same as 50 and 50, 100. Or should Company B restate its comparative figures so that it also shows 50 and 50 profit in the second year? What do you think? What is the objective of financial reporting? To help investors, lenders, and other creditors make decisions. So if you're thinking about whether you should invest in Company A or you should invest in Company B, if Company B shows 40-60, 40 profit in the first year, 60 profit in the second year, Company A shows 50-50, which company do you want to invest in? Company B. It's a nice growth company, is it? No. Okay, so you don't have to remember that we correct prior period errors retrospectively. Once you understand the objective of financial reporting, it's obvious the only right answer could be 50-50. Investors and lenders are trying to decide about whether they should invest or lend in A or B. They need comparable information, don't they? They need relevant information that's faithfully represented. What's faithfully represented? Profit of 50 in the first year, profit of 50 in the second year. Same for this company. And then you need some disclosure about that this company actually made an error. So on the margin, this company's better. It didn't make an error. The systems must be slightly better. Okay, so it's not something you have to remember. It's not arbitrary that the standard setters decide that prior period errors are corrected retrospectively. It's common sense if you look at the objective of financial reporting. Okay, and that's what we're trying to convey in that slide. Now, there is a cost constraint. So you might think, well, if I was the IASB and I was setting standards, all I have to think about is, well, what information would best suit investors, lenders, and other creditors who can't demand information? And that's fairly obvious to me most of the time. But when the IASB set these requirements, they don't always ask for the information that I think is obvious. So one of the main reasons for that is the cost constraint. The IASB cannot set a requirement where the cost of complying with that requirement is greater than the benefit of the information that that requirement generates. So every time the IASB sets a requirement, they're saying, do the benefits exceed the costs? If they don't, what's the next best requirement that we could set? So in the basis for conclusions, you see where the IASB has applied the cost constraint in setting each of the individual standards that it sets. And a very common example is where you have a new IFRS requirement. So remember when we looked at Company A and Company B and we said if there was a prior period error, we would require retrospective restatement? So if we have a new IFRS that has a different accounting requirements from an old IFRS, the new IFRS should have better information. For comparability over time and between entities, wouldn't it be best that both entities or all entities that use IFRS retrospectively apply that accounting policy? In other words, redo their financial statements as if that accounting policy had always applied, the new IFRS? Yeah, it would provide better information, wouldn't it? But the cost of doing so, imposing that cost on all the preparers out there, might exceed the benefit of doing so. So most new IFRSs aren't applied retrospectively. They say you apply this IFRS prospectively from this date. Most do, don't they? Okay, that's an application of the cost constraint. The better information would be retrospective application. But application of the cost constraint means that we have these transitioning provisions for new IFRSs, and often that means applying them prospectively. Okay, so accounting is really simple. Okay, we have 5 elements: assets, liabilities, and equity in the balance sheet, and income and expenses in the performance statement. And that's it. And you know from bookkeeping that your debits have to equal your credits, that your balance sheet has to balance. So when you've got one, you know the other one must be one of the 4 or the 5. So it's fairly straightforward, isn't it? Okay. Well, not really, as we're going to see in a moment. Okay. But all these definitions hinge around the definition of an asset and a liability. So the most important definition, the cornerstone element, is asset. So understanding in which situations we do have a resource which is under our control and from which we expect to get inflows is the cornerstone of IFRS. Then liabilities is kind of the opposite of that. You have a present obligation, you're expecting outflows, not inflows. Income and expenses are changes in assets and liabilities, other than where the owner puts money into the business or takes money out of the business. And equity is if you take all your assets, you minus your liabilities, what you're left with is equity. So it's important to see that the definitions of income, expense, and equity are based on the definitions of assets and liabilities. Changes in assets and liabilities are income and expenses. Okay, so some of these elements belonged in the balance sheet, financial position, if you like. So information about your assets and your liabilities helps people predict what future cash flows might be for an entity. Remember that definition of an asset, so you've got it about 2 slides back. We're going to look at these and decide whether we have an asset or not. Now, we're not looking at a particular IFRS. We're just trying to decide, from a conceptual point of view, do we have an asset or do we not have an asset? Okay, so A is yes, we have an asset. B is no, we don't have an asset because we don't have a resource under our control. And C is no, we don't have an asset because there are no expected future economic benefits. So the definition of an asset broken down into the 3 parts, if you like. Okay, so what about a fish farmer's breeding stock? So if you're farming fish in tanks, are those fish that you farm assets? Yes, there's clearly a resource, the fish, and you clearly expect economic benefits from it, probably selling it. Okay, so clearly you have an asset. Now what about the fish in the sea? If you're a fish harvester, so your business is taking a boat with some nets, going out into the sea, throwing the net over some fish and hauling them onto the boat. Are the fish in the sea your asset? No, no control. So it's easy, isn't it? Okay, what happens if you're exploring for oil? Your business is exploring for oil, and you estimate there's a 10% probability that you will find oil. Is your exploration rig an asset of yours? There is only, you think, a 10% chance that you'll find oil. If you do, you're going to be rich. but there's a 90% chance you're going to be poor. This is real business. People do this. What do you think? It's tempting to say no, isn't it? Because you're thinking no expected future economic benefits. But there are. You wouldn't be doing this unless you expected future economic benefits. You expect future economic benefits. 10%. Yeah. Okay, there is an expectation. You would not be doing this if there was no expectation of future economic benefits. Okay, so we're getting into more tricky ones. We always start with some easy ones. So the oil explorer, if you were regulating an oil explorer, their oil rig would be their asset, wouldn't it? Their rig that goes around searching for oil, their exploration rig. Even though there's only a 10% chance they'll find oil. What about in-process research? So we've now a pharmaceutical company, and we're searching for a new cure for something. We're doing research, but we haven't found anything yet. Is that research an asset? Is the research a resource controlled by the entity from which we expect a future economic benefit? You want to say no?
Because there is no some asset which we can present, like we have something finished good.
Okay, so you've documented your research.
It's just research.
Okay.
But, we have not anything to present, like some results, tangible results.
Okay, we have results, but the results are saying the experiment was not good. And what I'm trying to get to is, well, at the very least, you know you don't have to repeat that experiment. Okay, so many people would argue with research, there is an asset. But it's getting more difficult now, isn't it? We know IFRS won't let you capitalize that research as an asset. But at the very least, you know you don't have to repeat that experiment. Okay, so some people would argue, many people would argue that there is an asset. You do have a resource. You know that research that was done and it didn't give the answer, so you've narrowed the field of research to find your solution. So you would buy, and if you still think there's no asset, why do companies buy other companies' research even when they haven't found the cure yet? That research has value. Okay, so it's interesting. Okay, so we're not speaking about what IFRS makes you do yet. We're just looking at our conceptual framework and saying, do we have an asset? Okay, and what about our brand? It really fascinates me in the world. You know, people buy clothing these days with companies' names written on it, and I always thought the company must be paying them to wear that because they're advertising for. Turns out that's not true. People pay a lot more money for a shirt that has something written on it than they pay for a shirt that doesn't. Okay, it might just say something about the world we live in. There we go. Okay, so a clothing designer's internally generated brand. Is that a resource controlled by that entity? Okay, I was in Disneyland with my daughter last week. And, you know, there's a good quality shirt, and then there's a poor quality shirt with a Disney princess on. And the poor quality shirt with the Disney princess costs 5 times the price of the good quality shirt without the Disney princess on. And what shirt do you buy? The poor quality one with the Disney princess on. And you pay 5 times more, and you do that happily, don't you? Well, not so happily, but you do it, and that's the point. Does that brand have value? Is the brand a resource controlled by the entity? Yeah. It's an asset.
We have the question, can we sell this?
Ah, that's a good... Okay. Well, that's proof of the value, if you like, but it's also proof of the value, the fact that we'll pay for this more expensive thing because there's something on the outside of it. Okay, so again, I think there is an asset. Now, for those of you that are going no all the time to this, you're probably thinking of, well, what is the IFRS requirement? And the IFRS requirement is we don't show these as assets, isn't it? But if you buy the Disney brand, then you show the Disney brand in your books. It's not buying it that makes it an asset. It was an asset to Disney long before you bought it. Okay, just the IFRS requirement, we're not at the requirement yet, but when we get there, is not to put it in the book. So we're just trying to understand the definition of an asset now. No. Okay, well, it depends what accounting standards you're applying. If you're applying IFRS, you're not applying the conceptual framework to get the answer, except in some cases you're applying the standards themselves. But to understand the requirements, it's good to understand the platform on which those requirements are built, and particularly where they're not consistent with that platform, to understand why they're not consistent. Okay, so it's not going to change your balance sheet. It always amazes me, though. You see, we've got an exposure draft out about new leasing requirements, and this is going to add billions of liabilities to companies' balance sheets, apparently. Well, those liabilities are, those companies have those liabilities. Putting transparency over those liabilities doesn't change the fact that they have those liabilities. Those liabilities exist. IFRS to this date just hasn't required them to be on the balance sheet. So we don't change the economics by putting transparency over it. Okay, I think the liability's there. By putting it on the balance sheet, it's just being more transparent about it, I think. Okay, so now we've got and this is an interesting one, which we're going to spend some time on tomorrow in much more detail. Okay, so now we've got a jeweler, okay, and the jeweler enters into a contract with a gold miner to buy at a future date 100,000 ounces of gold, and we fix the price at 1,000 per ounce. We get to our balance sheet date, and the gold price is trading at 1,500. Are we happy to have this piece of paper if we're the company that's got this piece of paper? Are you glad you've got a piece of paper that's saying you can buy gold at 1,000 when everybody else asking for the same piece of paper today would be getting it at, say, 1,550? Are you glad you've got that piece of paper? Is that piece of paper an asset? I think it is an asset. It's a resource controlled by the entity. Okay, we're going to spend some time on that one later. Now let's look at liabilities. Okay, we're going to ask ourselves, are the following things liabilities? Okay, so the definition of a liability, a present obligation, an obligation right now, and we expect an outflow. That's what we're looking at. Okay. A provision for self-insurance. So companies recognize that the insurance companies that you regulate tend to be fairly wealthy companies, because that's what insurance companies do. They make a premium, they work out what the risk is, charge a premium over the risk. Okay, so they should become wealthy to take the risk away from us. So some companies say, no, I'm so big and diversified that I can bear the risks, I don't need insurance, or I'm just not risk averse, so I'll just take the risk. Okay? But what I'll do is I'll create a provision for self-insurance. So what the company would like to do, okay, is put some money in a separate bank account, okay, but then they would also like to have the expense this year, in the period they put it in the bank account. Nothing bad's happened. Okay, so no insurable event has occurred, if you like. Okay, all they're doing is putting some money in a separate bank account, and they'd like to debit expense and credit provision for bad thing that will happen in the future. If they'd paid the insurance premium to an insurer, I think we'd all agree it's an expense, isn't it? And if they owe it because they've received the insurance cover but haven't yet paid, it would be a liability. You agree? They haven't yet paid the insurance premium. Now they're self-insuring. So they put the money in a separate bank account, debit bank, credit bank, because it's still your bank account. They're just putting the money aside. Now they also want to debit expense credit liability, provision for bad thing, whatever it is, fire, whatever, earthquake. Do they have a liability? What's the liability for? What's the present obligation? No present obligation. Then there's no liability. So they can put money in a separate bank account. They can debit bank, credit bank as many times as they like in a day. Okay, but there's no liability. There's nothing to credit, is there? There's no debit expense, credit liability. When disaster happens, maybe 10 years later, then they'd have to impair all the assets that were destroyed, wouldn't they? You could do something in equity. There would be nothing wrong from an IFRS. So you'd have noticed with IFRS, we don't tell you different categories of equity very much, do we? We just say equity, don't we? Because every country has its own rules about non-distributable reserves and distributable reserves. So each country's law kind of decides within equity what the categories are. Pretty much. We have a few exceptions, but pretty much country law decides what categories of equity. But if the country permitted and a company wanted to create a reserve, okay, that's absolutely fine. But that would just be, debit distributable reserves, retained earnings, and credit a non-distributable reserve. So that would be fine with us. Yeah.
Where can you cannot have provisions for self-insurance? For example, you can be a seller of technical stuff.
Yeah.
And you know that you have 5% of them will, under warranty, will also come back to you.
Oh, okay, that's a different thing, though. Okay, because now if I'm selling something subject to a warranty, okay, then I have a liability because I've promised to take something back if it's... So my obligating event is selling something with a promise to accept the return or the refund or whatever it is. So your obligating event is selling it with that warranty obligation. So there you have a present obligation. So with that one, you do have a present obligation. Okay, because you've sold something with a defect with a promise to return it. Your obligating event is there. With self-insurance, this is, well, we might have a fire at some time in the future, so let's put some money aside. No obligating event now. Okay, and there's some others. In the interest of time, I'll skip over them, but we use some words, provision, in a horrible way. So we speak about, we don't anymore in IFRS, but just accountants speaking will say we provision for doubtful debts, provision for depreciation. Okay, those aren't provisions, those aren't liabilities, those are just words that we use. How do I get rid of that?
Is this according to IFRS 37 or contingent liabilities? Is different than impairment or something like that?
Well, yeah. Well, with impairment, you've got an asset and something's caused its recoverable amount to decline. So where you have an existing asset, so going back to your warranty example, you'd have a liability for the warranty promise that you've made on items that you've sold for defects. If you had some inventory that had that defect, you would test the inventory for impairment.
And I would make provision under IFRS.
Well, no. Okay. Impairment is under IFRS, impairment expense, so debit impairment expense, credit asset. Okay. Just colloquially, when accountants are speaking, they often call that a provision for something. Okay, but a provision in IFRS, when we're speaking technically, okay, is a liability of uncertain timing or amount. Okay, so we just use the word unfortunately, shall I say.
Provision is not equal to liability.
No. Well, a provision is a liability of uncertain timing or amount in IFRS. So it's your warranty provision. But a provision for doubtful debts is not a liability at all. It's not a provision. So in IFRS, we don't say provision for doubtful debts. Yeah. But, yes. Yeah, it's unfortunate. Okay, I'll skip over that one to look at some others. Okay, so let's take the third one on this slide. We issue a 3-year convertible bond, and we get proceeds of 1,000, so it can be converted into ordinary shares. We're paying interest at 6% per year. The bondholder has the option to convert it into ordinary shares, 250 ordinary shares. If we had issued the same debt instrument without the conversion feature, we would have had to have paid 9% interest instead of 6% interest. Okay, so now we get 1,000 cash in, so debit cash 1,000. What do we credit? Part equity, part liability, because the economics of what we've done is we've issued mandatory redeemable debt that we have to redeem, and we've issued an option to acquire our ordinary shares. So there's an equity component and there's a liability component. So it's a compound financial instrument, which we're going to split into 2 parts. There's a nice case study on the 3rd day, which deals with splitting compound financial instruments. Okay, now we subclassify. So we've classified into elements: asset, liability, income, and expense. Now we subclassify beneath that. Okay, and we do this, our conceptual framework says, because it helps us identify the strengths and weaknesses, it helps us to identify liquidity and solvency issues, and it helps us to identify financing needs and how successful the company is likely to be in meeting those financing needs. Okay, so with assets, we're also classifying them separately so we can see those assets which we get direct cash flows from. So say an investment property, you get direct cash flows from, whereas property, plant, and equipment, you get indirect cash flows from. So separating them out helps us better forecast cash flows. Okay, now we're looking at specific IFRSs. Okay, so which IFRS deals with each of these items? So in IFRS, you would have the definition of inventory, a definition of property, plant, and equipment, a definition of intangible assets, definition of investment property, definition of biological asset and agricultural activity, definition of a financial asset. It matters because once we subclassify, that tells us which IFRS applies to it, and those IFRSs have different recognition and measurement and derecognition criteria and presentation and disclosure requirements, don't they? So this matters. Which IFRS applies is what we're looking at now. Okay, so a cattle farmer's breeding stock. A, B, C, D, E, or F. Okay, so it's a biological asset, a living plant or animal, and it's in agricultural activity. It's been actively managed. Its biological transformation has been actively managed, okay, either to harvest meat from it, okay, or to get calves from it. What about a personal security firm's guard dogs? A personal security firm's guard dogs. Property, plant, and equipment. The dog is a machine. It's the right answer. It is a biological asset, but it's not in agricultural activity, is it? So it's not in IAS 41, so E would be wrong. B is the right answer, because the definition of property, plant, and equipment is that it's a tangible asset. You certainly can touch the dog. You're holding it either for rent or for providing a service in this case, okay, or for manufacture, not what you're doing here, okay, and that you're going to use it for more than 1 year. Okay, so it would meet the definition of property, plant, and equipment. What about the next one? And remember, I said we get incrementally difficult when we do these. What about a bird breeding zoo? The birds in a bird breeding zoo. Okay, so there are 2 cash flows. The one cash flow is you and me and everybody else thinks these exotic birds look quite nice, so we go to the zoo, we pay an entry fee, and we go and observe them. Okay, so they provide that service to us of viewing the birds. And then the other thing they're doing is they're breeding the birds, and then they sell the offspring.
Are they breeding birds or they are offspring of breeding birds?
So I think you raise a good point. We could have some birds at the zoo that we're breeding with and some birds that we're not. So the birds we're not breeding with certainly couldn't be biological assets in agricultural activity. Even, okay, well, we might harvest feathers and a few things from them, and then the question gets a bit stronger. Okay, but you could make a separation. Some you're breeding with, some you're not. What if we're breeding with all these birds? So what about the ones that we are breeding with? Are they biological assets in agricultural activity, or are they property, plant, and equipment? Because you're getting two cash flows. People are paying to come view those birds, but they're also breeding and you're selling the offspring. Okay, not inventory, because if we were buying and selling birds without breeding them, then we would be in inventory. Okay, so it's another one that's close, but if you're a farmer, which is effectively what we are in our breeding operation, then you're not in inventory, you'd be in IAS 41. But it's bothering you, isn't it? Because it's not coincidence the first two examples that we did. The one biological asset was property, plant, and equipment, and the other one was biological asset in agricultural activity, wasn't it? Now this one has characteristics of both, doesn't it? And there's no IFRS for characteristics of both. So now you have to make a judgment. Okay, it has to be one or the other. It can't be both. You can't say I'm accounting for it partly in IAS 16 and partly in IAS 41. It must go into one or the other. So that's what you've got to make a judgment about. So let's say the breeding operation was insignificant. If the breeding cash flows were insignificant, yeah, it's an application of materiality in a way. Okay, and then you would say the classification is property, plant, and equipment, wouldn't you? Sometimes it can be more difficult, and IFRS says we know you're going to come across situations where it's difficult to classify assets. Therefore, if you have battled to apply an accounting policy that is significant, you make special disclosures, don't you? IAS 1 has special disclosures about where you have battled to apply your accounting policies. You've battled to classify these either as IAS 41 or IAS 16. Make disclosures about it. Explain. Why did you battle? What's the relevant information? The accounting's quite different. If they're in IAS 41, they fair value through profit and loss, basically. If they're property, plant, and equipment, you could be using a cost depreciation model for them. The numbers are very different, so it matters. So that disclosure is important. The first thing I look at when I open financial statements, the auditor's report, see if it's qualified. After that, I go to look, where did they battle to apply their accounting policies? That's what I want to know. That's interesting information to me. Okay. Oh, the last one. Okay, the guy who wrote the standard came from New York. He wrote our agriculture standard. So we define biological assets as living plants and animals. Okay, so what happens if you're a mushroom farmer? Which standard would you apply? No, not inventory. Is it a biological asset? Okay, so I'm a nerdy guy. So there are 4 categories. There's fungus, bacteria, plants, and animals. Okay, so you shouldn't let a guy from New York write a standard about what a biological asset is. Okay, so I'm sure you would just apply IAS 41, but if you know, it's strictly speaking not a living plant or animal. A fungus is something that has its own category. It's not a living plant or animal. Okay, but that's just... Sorry? Well, the answer is, strictly speaking, it's not in the scope of IAS 41, because IAS 41 defines biological assets as living plants and animals, and a fungus is neither a plant nor an animal. Okay, but just...
Why is it not implemented
The same reason the sheep or the cow or the elephant or the whatever you're dealing with isn't inventory. Okay, because there's a separate standard which deals specifically with biological assets in agricultural activity. So if there's agricultural activity...
And if you are a firm and you are selling wheat, is this wheat a biological asset or your inventory?
Okay, it depends. If I'm trading, so I'm buying wheat from farmers and selling it to other people. I'm not growing wheat, I'm trading in wheat. I'm buying wheat and selling wheat, okay? Then it's inventory. But if I'm the farmer growing wheat, then it's a biological asset in agricultural activity until I harvest the wheat. When I harvest the wheat, then the wheat becomes inventory.
Then these mushrooms are maybe
I think it's just a not very... There was an oversight in writing the standard not to apply specifically to fungus. Okay, so performance. We are trying to measure performance is what we are trying to do. So whilst we define income and expenses as changes in assets and liabilities, that doesn't mean that we focused on the balance sheet. It just means the way that we're calculating income and expenses is based on changes in the balance sheet, because we think that's a robust way of doing it. Okay, we think there's less room for people to manipulate their financial statements if we base the definition of income and expenses on the definition of assets and liabilities. So we use the accrual basis. We think changes in economic resources, changes in assets and liabilities, help people to predict what future cash flows might be. Now we get to recognition. And recognition is interesting because remember I said you might think, if you're an economist, that if we had an asset or a liability, we'd put it in our balance sheet. Not true though, is it? Because we have recognition criteria. So once we've decided we have an asset or a liability, we decide which standard applies to that asset or liability, and we look at the recognition criteria in that particular standard. Our conceptual framework says generally when we're writing recognition criteria, we look for two things. Once we've decided we have an element, we look for two more things. Is it probable that we'll get a cash inflow for an asset? Is it probable that we'll get a cash outflow for a liability? And can we measure the cost or value reliably? Okay, so those are the two additional criteria. And sometimes we don't require the recognition of assets or liabilities because they fail these recognition criteria. And individual IFRSs show how they apply probable and measured reliably. So probable is an interesting word. In some standards, like IAS 37 on provisions, we say probable means more likely than not, greater than a 50% probability. In other standards where we're doing fair value measurement, for example, probable is greater than a 0% probability, like with derivatives or biological assets in agricultural activity. So you look at the individual standard to see what probable is interpreted as for that particular asset or liability. And when you look at development expenditure in IAS 38 on intangible assets, probable has a whole lot of qualitative requirements that need to be met in order to recognize development expenditure. So there are qualitative characteristics in that standard to describe what probable means. And what does measure reliably mean? Okay, now IFRS is full of judgments and estimates. Almost every number in IFRS is an estimate. And that might surprise some of you. Okay, and we're going to look at some examples of why even things like historical cost are often estimates. Okay, they are not precise numbers. Okay, so we accept that we're going to have lots of estimates because we want relevant information. We're not looking for precision, we're looking for relevant information. Okay, so would we recognize these assets and liabilities? Okay, so to recognize them, we're just looking at our conceptual framework now, not at an individual standard. two recognition criteria once you've decided you've got an asset. Is it probable we're going to get future economic benefits? Can we measure its cost or value reliably? So a hospital has a backup generator. So the hospital gets electricity from the national grid. If the national grid fails, the backup generator kicks in and provides electricity. If the backup generator fails, the backup generator kicks in to provide electricity. Is the backup generator a recognizable asset? Can we recognize the backup generator? Okay, to recognize it, it would have to be probable that we're going to get future cash flows from it, and we'd have to know its cost or value reliably. So you paid $1 million for it, okay, you know what its cost is. Is it probable you're going to get future economic benefits from it? Okay. We expect never to use it. We hope never to use it. We expect never to use it. Okay, to answer the question, would you rather go to a hospital for your operation where you're going to be under general anesthetic and if the electricity fails, you're dead? Okay, would you rather go to a hospital that has a backup generator, or would you rather go to a hospital that doesn't? You would rather. Okay, so you would be prepared to pay something more, or you would be more inclined to go to that hospital? Is that hospital going to get a future economic benefit from having a backup generator? Yes. Okay, it's a recognizable asset, even though it is unlikely that they will ever use it. Okay, unit of account is something that we don't speak about enough. Okay, so all unit of account is if I buy, say, all the bottles of water that are here, do I account for one bottle of water, or do I account for the batch of bottles of water that I bought? So some standards tell you, inventory is one that does, it's item by item. Okay. Property, plant and equipment doesn't tell you. It doesn't tell you what the unit of account is. Financial instruments often do tell you. It's the individual instrument. Okay, property, plant and equipment doesn't tell you. So there you have to use your judgment in deciding what a unit of account is. Okay, so here's an example to illustrate some property, plant and equipment. We buy a factory, a manufacturing plant. There's a factory building. It's the main structure and it's a roof. There's a shredding machine. There's a pulping machine. There are 5 forklifts. There's 1,000 reusable molds, and they have a range in value. How many items of property, plant and equipment do we have? Let's start at the top. The factory building, is that 2 items, the structure and the roof, because we do component depreciation? Or is it 1 item and we depreciate the components of that item separately? 1 item or 2 items? 1 item. Okay. And we depreciate the components separately. Okay. The second one, the shredding machine and the pulping machine. 1 item or 2 items? Or can we consider it to be part of the factory building? Okay, 2 items. They both look reasonably material. Okay, so I think 2 items, so I agree with you there. You're applying judgment, by the way. Okay, 5, okay, and let's go to the last one. 1,000 reusable molds, each worth between 1 and 100 currency units. 1,000 plus items or 1 item, batch of molds? Sometimes there's not a right and a wrong answer. Sometimes either answer is right. Yeah. Okay, because it's material as a separate item, it would make sense to account for the building separate from the shredding machine or the pulping machine. Oh, why 1 and not 2? Okay, sorry. Okay, so when you look at IAS 16 and you look at the depreciation, it says we do component depreciation. So it says you'll depreciate the roof probably separately from the building, okay? But your item is still the entire building, including the roof. Okay, so the fact that we will... Because there's a further subclassification within property, plant, and equipment only for the purposes of depreciation. So your item is the building including the roof, but for depreciation purposes, that item can be broken down into smaller items. Like a car, for example, you could break the car into the engine and the body. Maybe the exhaust is a separate component if you wanted it as a separate component. Okay? You probably wouldn't, it's not material, but you could. Okay? That doesn't change the fact that you've got one car. Your item would be a car and you would depreciate those components separately. So it's just the difference between an item and then just for depreciation purposes, how we're consuming the service potential of that item.
Let me go on calculator. I have a building.
Yeah.
Now I decided to buy a heating system.
A heating system, yeah.
Is it going into the building?
Okay, there's an interesting question here. So now we have a building, but there's a heating system in the building when we buy it, just to modify your example slightly. You get the same answer. So if when we bought this building, it had a ducted heating system, like this building probably has ducted air conditioning. There's just air conditioning seeping out of the roof somewhere. Is that air conditioning a separate item, or is that part of the building?
Part of the building, you cannot sell it. Probably you cannot sell it without the building.
Okay, so if it's a structural part of the building, like it's integrated in the building, then it would be part of the building asset. Okay, but you might depreciate it separately. If it's a standalone one, like you sometimes get the standalone box unit, then it's probably a separate asset, not part of the building. But again, you would apply materiality again.
And when I buy the heating system after that, I have to
Okay.
capitalize on the building
Yes.
amount.
Yeah, I would say so. If you then put a ducted air conditioning into the building,
Just different depreciation.
yeah, and depreciate it separately. That would make sense. Now, the one that we haven't discussed is the middle one. Okay, and once we've discussed the middle one, I think we have to break for lunch. So just for the middle one, 5 independently operated forklifts. Individually, 15 to 25,000. In total, we'll have to change the 80 to 90, otherwise the maths doesn't work. But anyone think we could just collectively account for all the forklifts?
They are material by each unit, so it's better to account them.
Okay. Okay, I think here we're in the judgment area. I think there's certainly nothing wrong with your answer. You could account for everyone separately. I think I'd just want to see some more facts and circumstances about the business to see whether I'd account for them separately. Could you account for them collectively? Yeah, I think you could account for them collectively, but you would look at all the other facts and circumstances. Okay, so we start with obvious ones at the top. We've got a fairly obvious one at the bottom. In the middle, the judgment is harder to make. That's basically the point we're trying to make with this one. Okay, so we've been through recognition. We're now on to measurement. So, as I said, for measurement, we've decided to recognize something. So now it's what amount should it be at initially when we first put it in our financial statements. And then if it's in the statement of financial position or the balance sheet, when we get to the end of a reporting period, we might remeasure it. So remember, IFRS measurements are largely based on judgments and estimates. So we expect to make lots of judgments and estimates when we're measuring things. Our conceptual framework is not very good on measurement. It just lists a couple of different measures or a few different measures. It doesn't say when we should apply which. So there's a project now where the board is issuing a discussion paper in a month or so, which will look at improving measurement in the conceptual framework. But remember, the board is guided by the objective of financial reporting. So we're always thinking about what information would those investors, lenders, and other creditors find useful who can't demand information directly from the company. Okay, now here's a question. What is historical cost? Okay, so if we look in IAS 16, it says historical cost is the amount of cash or cash equivalents that we pay, so that's not difficult. If I go to the shop and I buy this for €1, then the cost of that thing is €1. So that's fairly straightforward, you would think. What happens if I don't pay with cash? I pay with something else, so I exchange. Then it is the fair value of what I give up. And then it says, well, sometimes some other standard might tell you what cost is as well. So for those of you that thought cost was a nice, precise figure, okay, you have to think again. Okay, cost can be precise, but so can fair value. The fair value of gold today is a precise number. Okay, the cost of this bottle of water, if there were no discounts or I just went to the shop and bought this one bottle of water, then I know what that cost is. And that's why when we use cost, if you look at IAS 16 as an example, paragraphs 7 to 28 explain further what cost is for property, plant and equipment. Because it's not a concept, it's a convention. And when you have conventions, you need to write rules, okay, to make the convention work in different circumstances. Cost is quite widely used in IFRS, so many things are initially recognized at cost. Inventory, property, plant and equipment, intangibles, investment property. Then we use the cost model for subsequent measurement for quite a few assets. As you can see, they're highlighted in red there, where we use cost or variance of cost. Okay. I'm going to do a little example with you, and you're going to tell me what the cost of this asset is. I pay $1 million for an option to acquire an aircraft. I keep the option for, say, 2 years. I then exercise the option to buy the aircraft when the option is worth $10 million. So when the option that I paid $1 million for is worth $10 million, I could sell it to somebody else for $10 million. I exercise the option and pay a further $100 million for an aircraft. What is the cost of the aircraft? Is it 100 million? Is it 101 million? Or is it 110 million? Okay, discuss it with the person next to you. You might not agree. Okay, so did you agree with the people sitting around you? I'm sure you did. Okay, who agreed with the people sitting around them? If you agreed, everybody at your table agreed, put your hand up. You all agreed? No one else agreed with the people sitting around them. Okay, I'm not surprised. Because what is the definition of cost? It's what we paid for it, or what we gave up to get it, and we paid for and gave this thing up. So some people would be thinking, oh, cost must be 101, because cost must be the one that I paid, which is sort of the first installment, and then the 100 that I paid at the end, 101. And other people would be saying, no, you gave up something worth 10 and you paid 100, so it must be 110. If the fair value is 110, but we're not recording it at fair value, we're recording it at cost. Okay, so we don't know what the cost of this item is, or we can't agree anyway what the cost of this item is, because it could be two things. Then it gets more interesting. Okay, let's say we'll take the third bullet point here. IFRS is clear. If you buy something, and you don't pay for it for, say, 2 years, so you're going to pay for it in 2 years' time, okay, you need to present value to work out what the cost is. Okay. What happens if I pay 2 years in advance? Okay, so if you're going to buy something for 1,000, that's 1,000 today. If you paid 1,000 today, you would get it today. Would you pay 1,000 today to get it in 2 years' time? Or would you pay less? Or more, perhaps? You'd pay less, wouldn't you? So what is the cost? If I pay 950 today for something I'm going to receive in 2 years' time, and the time value of money would be 50. Is it 1,000? The question came to our interpretations committee. What do you think? It came from Europe. I think the French asked the question. The standard doesn't tell you. The standard says it's what you paid, that's cost. So some would say cost is cost, so the cost must be 950. Others would say no. Surely if I'm going to pay less now for something that I'm going to get in a year's or 2 years' time because of the time value of money. So surely the cost must be 1,000. The standard even gives an example. It says if you pay later, you must present value back. It just didn't tell you what to do if you paid early. So we don't know what cost is again. So cost is not a precise number. It's a convention. So I don't think there's agreement in the world. Some people would say the cost is 950. Some people would say the cost's 1,000. As far as I understand, the Interpretations Committee didn't answer the question. Okay, so what is cost? We're sometimes not sure. Then there's cost allocations. Okay, so let's say we're a brick manufacturer and we decide to build a warehouse using our own bricks. What is the cost of the warehouse? So included in the cost of the warehouse is the cost of the bricks we manufactured. Included in the cost of the bricks we manufactured are a whole lot of allocated costs. Depreciation on machinery, rental allocations, all sorts of things, labor costs, all sorts of allocations. If those labor have a defined benefit plan, all the estimations that go into defined benefit plan accounting for their pensions, all those estimates are in there. Nothing precise about it. Nothing wrong with it. We know IFRS is full of estimates. Okay? But it's not a precise number, it's an estimate. That's the point. What about if we've got inventory where we say a chemical manufacturer? So the chemicals are manufactured in a drum where you add some chemicals, you mix them up a bit, you take some out, you add some more in. The ones that come out at different stages get processed further. How do you allocate all those common costs that you put in? Using a rational and consistent basis. Those are estimates. It is not a precise number. Okay, it must be both rational and consistent, not just consistent. Depreciation under IFRS is different from depreciation under most national gaps that I've seen. And I really think that depreciation is well written under IFRS. So what we're trying to do with depreciation, and there's a really good example in the case study, so let's think about this carefully. We're trying to represent how we consume the service potential of the asset. So what we're doing with depreciation is we're saying, let's show as an expense the amount of the service potential of the asset that we've consumed in the current period. That's what we're trying to do. That's our principle. Okay, and to do that, we make a whole lot of judgments and estimates. Okay. The principle says, if you look at land, if you use land for a year, do you diminish its service potential? Do you use up land by using it? Generally not. So we generally don't depreciate land. If, however, the land was, say, a municipal dump, where we throw all our waste, then you might depreciate that land, because that land does have a limited life then. Okay, so it's not a rule that we don't depreciate land. We generally don't depreciate land unless we are consuming its service potential through the use to which we put it. Okay. So now to estimate how we consume the service potential of the asset, we have to estimate the depreciation method. So which depreciation method best reflects how we consume the service potential of the asset? Then we have components. Remember, we already had the building, the structure, and the roof. We said we would depreciate those two components separately. We estimate useful life. We estimate residual value. So if I bought this computer today, and I intended to use it for 2 years, and then to sell it, its useful life would be 2 years, my intention for how long I intend to use it. Its residual value today would be how much would I be able to sell this for today if it was already 2 years old and in the condition that it will be in once I've used it for 2 years. It's kind of what is its fair value of an older asset. Okay, so lots of estimates. These estimates are important because we're trying to reflect economically how we're consuming the service potential of this asset. So there are lots of judgments and estimates that are going into this. Okay, what is fair value? We have a clear principle for fair value. It's the price that we would receive to sell an asset or the price we would pay to transfer a liability in an orderly transaction, not a forced sale, between market participants. So it's a market view. If you're making assumptions, what would the market's assumptions be at a particular date? That is a clear concept. It might be difficult to measure fair value sometimes, but we do know what it is that we are trying to measure. Whereas with cost, we don't know what we're trying to measure part of the time. Okay, so where is fair value measurement used? Well, this slide shows some for assets, some of the times that we use fair value, the revaluation model for intangible assets or property, plant, and equipment. For example, investment property, agriculture, some financial instruments. Measuring fair value for the gold, which is traded in an active market, deep liquid market, public information, there's no judgments, no estimates. It's very straightforward. When you get down to level 3 measurements, you might have a unique asset that you're the only person who uses that asset. Nobody in the market would buy that asset from you. You can still calculate its fair value. Okay, it might involve, for example, projecting its cash flows that you will get from it and discounting those to today's date. What would you be prepared to pay for it today? Would be a way of estimating its fair value. So unique assets, you can measure their fair value. It's just a lot more subjective. So derecognition of assets, we touched on today, and Martin touched on that when he was presenting. Okay, remember we said we'd expect that to be the opposite of recognition, the mirror image of recognition, but it's not. Our framework says nothing about derecognition, so you're looking at individual standards for how derecognition works, and we are not consistent from standard to standard. So you have to look at the derecognition requirements in each standard for each asset and each liability. So this has been discussed by the board at the moment, and this was January, but the discussion paper is coming out, I think, this month or next month. And one of the things they're looking at is recognition and derecognition. So should recognition be symmetrical with derecognition? Should it be a mirror image? Or does history matter? Should some things stay on the balance sheet just because we have recognized them before? Yet if we were to enter into a contract to buy them back, there might be no requirement to put them on our balance sheet today. So this we call stickiness. We keep some things in our balance sheet, even though if we had a transaction to acquire them in the future today, we might not put them in our balance sheet today. So we might not de-recognize something that no longer meets our recognition criteria too. We have specific de-recognition criteria. So with financial instruments, from the banking people here, you see this. There's stickiness in financial instruments, where financial instruments can stay on the books, okay, even though they no longer meet the recognition criteria. So this relates again, I think, to the example that Martin was doing with you this morning. If history matters, you might debit cash when you get the cash and credit liability. If it doesn't matter, you can debit cash, de-recognize the asset, and recognize a gain. And you've got a forward contract to buy the asset back. Okay, so you look at the individual standards to get the guidance on that particular instrument, what applies, or that particular item, what the recognition and derecognition criteria are. So this will matter when we do the Open Safari case study later this afternoon. These are IAS 16's derecognition requirements. Their recognition criteria were, it's probable you'll get an economic benefit, and it has a cost that you can measure reliably. That was the recognition criteria. The derecognition criteria are, you've disposed of it, you can dispose of it by sale or abandonment, or you no longer expect future economic benefits from it. That is not the mirror image of recognition. Okay, so remember this when we come to this afternoon. There's part of a case study that deals with that. Okay, so presentation. We separate elements, assets from liabilities, from equity, from income, from expenses, from cash flows. We separate these things out. Then we subclassify based on the nature or function in the business of assets. So a piece of land could be investment property, it could be inventory, it could be property, plant, and equipment, depending on the purpose to which we put it in our business. You agree? If you're holding land to get rental income or capital appreciation, it's investment property. If you're holding land to build your head office building on it, then it's property, plant, and equipment. And if you're dealing in land, it's inventory. So the purpose to which you put it in your business matters. And then say it's property, plant, and equipment, we can subclassify further within property, plant, and equipment into classes of property, plant, and equipment. So land might be in different categories, and we've got an example where we'll look at that. Here it is here. How many classes of property, plant, and equipment do we have? Okay, so we've got a plot on which our headquarters is built. Okay, so we've definitely got one category of land with a headquarters, a building built on it. Then we've got a vacant plot of land. Okay, so if you look at the vacant plot of land, is the nature of land different when it has a building built on it? Yes, I think it is. And the use? Well, the use is the same. We're going to have headquarters constructed on it. So I would say a vacant plot needs to be a separate class from the plot on which you have a building already erected. So that's two already. Then what about land that is used as a landfill site? Okay, so going back, its use is quite different. Its nature is different because it's excavated and you're throwing rubbish into it. In fact, you'd probably depreciate that land. So there's a third category within land. Then we've got some sales offices built on land. That land, okay, it's getting more difficult now. Maybe it's the same as having a headquarters building, the nature and use similar. And then you've got 10 in different cities with retail outlets. Maybe they're different, maybe they're the same. It's getting more subjective now about whether that is a separate class or not. What about the last one? A plot acquired for an undetermined purpose. Okay, this isn't property, plant, and equipment. This is investment property. Okay, the basis for conclusions in IAS 40 said it's investment property because to make a decision to put it to whatever use you finally decide is an investment decision, therefore it's investment property. Okay, so disclosure. In the notes we provide narrative explanations. We break down further the amounts that we have in our balance sheet and income statement and other statements. And we also make disclosures about things that we don't recognize. So contingent liabilities is an example of that. And the last bullet point says, if you've applied IFRS with additional disclosures when necessary, you end up with a fair presentation. Okay, so it's not just complying with the disclosures which are there. In fact, many you might not comply with, or you'll comply with them by not writing anything because they're immaterial. But you also have to consider what else might be useful to investors, lenders, and other creditors that can't demand information from you. And you have to make those additional disclosures. So because there is no explicit requirement to disclose something, does not mean that item does not have to be disclosed. It has to be disclosed if it is important to a user's decision. Okay, so does the framework help one apply IFRS? Okay, so our case study is going to be on the IAS 8 hierarchy that we're going to look at in a moment. So what happens if there is no explicit rule in IFRS on how to account for something? Then you go to IAS 8 paragraph 10 and it tells you how to do it. So preparers have to know the framework in order to be able to apply IAS 8 paragraph 10. Auditors have to audit those decisions. Regulators have to regulate those decisions or those judgments. And investors, lenders, and others have to consider the information that arises from those decisions. Okay, so if there is no explicit IFRS requirement, we have to develop a policy that results in relevant information. Remember the first fundamental qualitative characteristic, relevant, to help them project future cash flows. It must have predictive value, confirmatory value, and there was materiality. And it must faithfully represent, so it must be complete, it must be neutral, etc. Then you get some guidance in paragraph 10 of IAS 8. It says the way you apply the IAS 8 hierarchy is you first see if there's an IFRS that deals with a similar item. Then you can analogize to that similar item to get your accounting for the item for which there is no IFRS. If you can't do that, you go back to the definitions, recognition criteria, etc. in the conceptual framework, and you write accounting policy as if you are the board writing a standard. So in a framework-based approach, if you're coming to apply the IAS 8 hierarchy, the first question you would ask is, what is the economics of this phenomenon? So this transaction, this item, okay, what is the economics that you're looking at? That provides context for you to think about what would be relevant information for investors, lenders, and other creditors. Then you say, is there anything in IFRS that prevents me from providing what I think the most relevant information is? Okay, so I'm going to take an example which our interpretations committee has considered. They have issued an interpretation, so we know what their answer to this question is now. So this is mandatory now. You have to apply this in IFRS. If a company in this example had an asset which was in its books at 1,000, but its fair value is now $1 million, and it takes that asset and it distributes it to its shareholders as a dividend, what is the accounting? So this came to our interpretations committee because some people were saying the accounting is derecognize the asset, So credit asset 1,000, debit distribution 1,000. Other people were saying no. What you've got here is you've got 1 million being distributed to the shareholders. So the accounts should reflect 1 million being distributed to the shareholders. So they showed first a gain, so debit the asset, 999,000. Credit income, 999,000, profit. And then distribute the asset of 1 million. Debit distribution 1 million, credit asset 1 million. Big difference, isn't it? 1 million profits difference, basically. Okay, so for this one, think of yourself as an existing lender, somebody who had lent money to this company. And this company takes an asset which it's got at cost and distributes it to its shareholders. What is the economics from your perspective of what's happening? You had a claim against the company. The net assets or the assets available in that company to meet your claim have just gone down significantly, haven't they? The company might not be able to meet your claim. It happens to creditors all the time, doesn't it? So if you get information that just says 1,000 left the company, nothing to worry about, don't worry. Or do you need information that 1 million left the company, and maybe you have something to worry about? You're a lender that doesn't have the power to demand information, like a trade creditor, lending to a big organization, selling on credit to them. What do you think? Okay, well, first, what is the economics of what's happened? Do you think the economics is that 1,000 was given out or 1 million? 1 million. Okay, so could we provide 1 million as the answer? Okay, and that's what the IFRIC said. The Interpretations Committee said, of course, you have to show the 1 million. You can't show the 1,000. When this was issued, I actually went to speak to the chairman of the Interpretations Committee, and I said, I don't know why you issued this interpretation. You should have just told people to look at the objective of financial reporting. Because the answer is obvious. Why it needed an interpretation, I don't understand. Okay, but the right interpretation is given. The economics is clearly 1 million. Your claim against the company is 1 million less assets to meet that claim. Okay, but the interpretation is there now, so it has to be applied by everybody. You could do the same for share-based payments. Before IFRS 2, if a company paid an employee in shares rather than cash, the question was, what should the accounting be? Okay, and it's the same thing. I think it would be quite clear that the employee did provide a service that was worth 1 million, and 1 million should be the expense. As that asset, that service is turned into an expense as it is received, it's 1 million.
Sorry, but the last example doesn't isn't it a little bit confusing for potential investors? Because you have dividends paid out in 1 million, and actually there was no cash flow.
So you would see a difference, hold on, because if the company had sold that asset for 1 million and distributed 1 million cash, you would see that as being completely different to the company just distributing the asset that's worth 1 million.
Yes, because this is the fair value of their claim of 1 million towards the company and their settlement of that claim with the land. Is this a fair price of this land? Or maybe just...
Okay. In the example, we're saying the fair value is 1 million. Okay, so we're not we're not questioning the fair value in the example. Okay, so in the example, I'm saying the fair value is 1 million, the cost is 1,000.
So that's been disclaimed then. The dividends paid out are settled in land.
Yeah, no, I think it would be fine to disclose it, to say, yes, the dividend was settled in land and we've accounted for it at fair value. But that is what the standard requires now because of the interpretation. But to me, whether we just distribute the land or we sell the land and then distribute the cash, it's just maybe transactions costs is the difference. Okay, the last thing I'm going to do before we get into the case studies is just deal with some myths, okay, some untruths that people commonly believe about IFRS. So the first myth is that our framework includes a matching concept. So what a matching concept is, some people think in IFRS when we recognize some income, we're saying what expenses should we recognize against this income, not what we're doing in IFRS. In IFRS, income and expenses are changes in assets and liabilities. Okay, we use an accrual basis of accounting based on the definition of assets and liabilities. The answer you get is sometimes similar, sometimes very different. We are not matching expenses against income. Income and expenses are changes in assets and liabilities. Some people think that we are conservative, and you certainly can see in some of our standards vestiges of conservatism. So before our conceptual framework, we wrote some standards. We might have done some matching. We might have done, some conservatism. We did all sorts of things before we had a conceptual framework. But our new conceptual framework going forward, okay, and we've had it now for a long time, this conceptual framework, no matching, no conservatism. It's neutrality, transparency, an even open picture. Now we record some things in other comprehensive income. So sometimes we have items of income and expense which we recognize in other comprehensive income. That's just a convention. There's nothing in our conceptual framework speaking about other comprehensive income. Okay, it is a requirement in our standards, but there's nothing in our conceptual framework. There's nothing in our conceptual framework that speaks about management intent and business model. In some of our standards, you see management intent and business model. Right now, when we're writing the conceptual framework, we've got a discussion paper coming out. These are some of the questions we're asking. Should we be thinking about management intent? Should we be thinking about business model? The banks had a business model. That worked out well. Some people think that principles are less rigorous than rules. Some people think if you've got a rule, then we'll get, comparability and everything will be right. Okay, but rules are the tools of financial engineers. If you write a rule for somebody, they structure the transaction right up to the rule. Okay, so they're not necessarily more rigorous than principles. But what we need is clear principles, and not all of IFRS has clear principles. So IFRS does need improvement. Like revenue recognition, for example. We're improving revenue recognition now with a new standard that's going to come out. But the one at the moment is not great. Okay, and there are other areas that need improvement too. Okay, and we've discussed that there are lots of judgments and estimates in cost-based measures, so I don't need to go through that with you again.